Hi, everyone. Katy here. Alissa is out today teaching a class, but we didn't want to miss this opportunity to talk to a guest. So this is episode 296. And Amanda, please tell us who you are, where you are, and what you do.
Oh, well, hi, everyone. I'm really excited to be here today. My name is Amanda Hahn, and what I tell people is I'm a CPA by day and real estate investor by night. My husband and I founded a company called Keystone CPA, and we work with real estate investors nationwide on how to use real estate to save on taxes. So that's our day job. And then, we are also real estate investors ourselves.
Perfect. I love that. Okay, so you're going to have some really specialized knowledge for the investor angle, obviously. But just to give some backstory, we are a podcast strictly for realtors. So they would maybe be passing this information along to a buyer client or investor client. And also a lot of real estate agents are investors themselves. So I know that they will take this information and be able to use it in their business as well.
Yeah, well, I'm hoping by the end of today, I'm going to convince every single realtor to invest in real estate.
Okay, good. I love that goal. What a perfect goal to have. Okay, let's just kind of start at the base. I know that a lot of agents, get into the business and they maybe aren't money savvy or feel comfortable, and you become an entrepreneur and you're wearing all the hats and you have to figure out, do I need a CPA? Can I do this on my own? What do you tell, I guess, an entrepreneur who's maybe overwhelmed by the financial side of business?
Yeah, I mean, I would tell them that you don't have to do it alone. You don't have to become an accountant and learn all of the tax law and the numbers. What you're really looking at as an entrepreneur with accounting, just sort of with everything too, right, is what is the highest and best use of your time? Where do your unique abilities lie? We have a lot of clients who are realtors and brokers who are awesome at finances, and they enjoy it. They like doing projections. They like running the financial side of their business. And for those people, it's great. You don't have to outsource it. It's just something you're passionate about and you're good at. But we also have clients who just absolutely hate that kind of stuff. And especially as, someone in real estate looking to scale, you have to just kind of weigh the cost and benefit associated, right? If I do my own books, I'm maybe saving, I don't know, $20, $50, $75 an hour, but what else could I be doing? How much income could I be generating if I simply outsource that and I spent my time looking for deals or meeting with clients? So it's a very personalized decision. I think it depends on where you're passionate on, where your unique abilities are, right? And just knowing that there's always help. You don't have to do it alone. And you don't have to become an accountant.
Yeah, thank goodness. I don't know what I would do without my accountant. It's so overwhelming to me that I'm like, it's just better. It's worth the money that I pay. Make sure I don't make a mistake. And I know that it's saving me money more than it's costing me, honestly, in the long run. So I think it is always worth it. Okay, the number one question we get from agents is, especially when we're like, hey, we're going to talk about money. Well, in taxes, do I need to be an LLC? Do I need to do S-corp? Can you give us the quick and dirty, what your advice is on that?
Yeah, I mean, I'll start by saying the answer to that question really depends, could be vastly different from one person to the next. And the reason for that is because when we talk about maximizing our tax savings, we're not just looking at realtor commissions. We're always looking holistically at what else you have going on. So one example and a starting point I always talk to people who ask me this question is, what other income do you have, first and foremost? So some people are full-time realtors. Other people are just starting to dabble on the side, but they still have a full-time job. And so I would want to know, do you have other income? How much is it? And of course, just as importantly, how much is the net profit you expect from your real estate activities? Because, and the important word here is net. People always tell me about gross, this is how much I think I'm going to get in commissions, but I actually don't care how much you're getting in commissions. I want to know how much is your profit after all of your expenses and write-offs. And so all that to say, the difference between personal name, LLC, S-corp is that the higher the net profit you have, the more likely it could be for you to earn that income inside of an S corporation. Reason being that S corporations help you to reduce self-employment taxes. So if you're just, if your net profit after expenses is $10,000, maybe it's costing you more money to form an entity, file tax returns, pay your CPA, pay your bookkeeper. But if you're someone making 100,000 or more, then maybe it is beneficial for you to become an S corporation.
Do you feel like 100,000 is a pretty good threshold for that? If you're netting 100,000, or it
I would
really still
say,
depends on what your other income is?
yeah, it actually still unfortunately depends on a lot of things. But I'll say, like, from a very high level perspective, if you don't have another job, if real estate is your full time job, then typically we start looking at the numbers and looking into an analysis when net profit is 40,000 or more. Okay, that's
Okay.
typically the starting point. And again,
Okay.
net after expenses, not just
Right.
commissions only.
I know. I mean,
Now,
we like
if
to just
you,
look at that big number.
yeah, right. And then it's like, but we have to look at the expenses and are we actually making money?
Right.
um, Now, if you're someone who has a W-2 job or run another business, then that threshold is typically much higher. So like if you're getting paid $100,000 at your job, then maybe you'll have to make 100,000 or more in commissions, net profit, to be, an S corporation. So again, that's kind of a little bit different. Like, what if you made 40,000 at your job, right? And that's where the deeper analysis comes in. But it's a little bit simpler when you don't have another job. Typically,
Yeah.
we start looking at the cost benefit at 40,000.
Okay. That makes perfect sense.
Hey friend, we just wanted to pop over and remind you of all of the freebies that we have on our website at hustlehumblypodcast.com/resources.
There are quite a few on there. They work for buyers and sellers, for your business, all different things you might need, and all for free. Alissa, which one is your favorite?
My favorite freebie is the due diligence checklist.
Oh, that's a good one and so impactful for your buyers.
It's a great email template.
It's a really good one. My favorite is probably the staging checklist. I want my sellers to have those houses looking good.
Yes, yes. So head over and see which ones you would like to download or get them all. Enjoy.
What do you see some real estate agents, entrepreneurs struggling with? Where are they making mistakes in their accounting and tax planning?
Oh my goodness. Well, just I mean, to be honest, I think just lack thereof for both. Not
No
having
planning at
accounting,
all.
no planning, and no accounting. Sort of like, well, I'm sure I'll figure it out when it's tax time and just, get all my bank statements. And I think that's, people always tell me like they hate taxes. But I think the reality is people don't hate taxes. Of course, we don't like to pay taxes, but people dread the process of filing taxes. And I think the number one reason for that is disorganization, right? I kind of pushed off a whole year's worth of stuff. Now I'm going to try to figure out what I spent money on. So I think that's the most common mistake. And then tax planning, yeah, very few realtors, even like brokers that I meet actually do tax planning. Very, very far and few in between. Most people tend to think when I'm meeting with my CPA to scramble and file last year's taxes, that's kind of like a planning session because I'm asking some questions. But that's actually not planning. That's just like you doing last year's taxes and asking some questions.
Right. So it's a more reactive approach, not a very proactive approach to your taxes and all of that. Okay. That makes sense. And that's true that I think we all fall victim to that pretty frequently. Okay. When they start up, so let's just say they're a new agent and they're going to do this full time. They've got some income coming in. What are some of the things that you would recommend putting in place to ensure long-term success for that planning, for that accounting, for your tax planning, all of those pieces?
Yeah, I think the first thing is systems. Systems is huge for entrepreneurs, regardless of what you're doing, and also in all aspects of business, right? Marketing, lead gen. I mean, and accounting is, taxes is kind of goes along those same lines. A common question I get from people is, what kind of software should I use for bookkeeping? And I always tell people it's not about the kind of software that I like as your accountant. It is about a system that you will actually use. Now, if you have a bookkeeper, that's easy. What does my bookkeeper use? QuickBooks, Stessa, great, let's use that. But if you're doing it yourself, if we're starting out with DIY, because we have budget constraints, then you want to work with a system that works best for you. If you're someone who's, computer savvy, QuickBooks is amazing because it interfaces with your bank, with your credit card, and it's more and more intuitive now where If Home Depot is always coded to repairs, it will auto suggest in the future, like, oh, repairs, you just have to say yes or no. Alternatively, though, not everyone is computer savvy. I've had clients who buy QuickBooks and then they put it on the shelf because they don't want to look at it. They don't want to download it to their computer, and then nothing gets done. So if you're someone like that, Excel is perfectly fine. I think the one main tip about having good system and good bookkeeping is having a separate bank account for your realtor activities. I don't care if you have an LLC or not. Even if you don't have an LLC, we will want Katy, for example, to have a personal bank account with all of the household stuff and a separate Katy's account that's just used for real estate. That will save you so much time when it comes to bookkeeping.
Yeah, that makes sense. And I think that's the easiest thing to do so that you actually know what you're spending. Like, what are you bringing in and what are you putting out in your business? If you don't have a separate account, it's all mixed up and you just are flying by the seat of your pants, no true idea of what's really coming in or going out. So I do really think, and that's the easiest tip. I feel like you can open accounts at your bank online at this point. Like, you just click a couple of buttons and you can have another account.
Well, and also, speaking of, opening easy to do for systematizing, one thing I always recommend people do is to open that business or real estate bank account in the same bank where your personal stuff is. Because what happens a lot is people will inadvertently pay for business expenses from a personal account. Like, hey, I'm going to this real estate convention and it's $3,000. There's no money in my LLC account. Let me just pay for it more personal. And all sorts of crazy stuff happens because you just continue to commingle. And the best and easiest way to avoid that is to make sure your business account is fully funded. And if it's at the same bank, it's very easy, like you said, Katy, just to transfer money. And then once it's transferred from personal to business, now I can just pay for it.
Yeah, I personally use that system where I have my business account and my personal account at the same bank. It really, and I am filing my taxes as an S-corp. It makes it super easy too for me to do my payroll because I just once a month, my CPA, runs all my payroll reports, tells me it's the same amount every month because we're using a standard salary. But I just make a transfer from my business account to my personal account. It's like super, it can be set on a date.
It's automated.
It always happens.
Yeah.
It's automatic. It's like really, it couldn't get any easier because when my broker pays me a commission check, it's written to that business account, to that business entity. So all the money for me, because it's my job, my only job, starts there. I'm not taking it from my personal account and going back to my business account to make sure I'm covering expenses. It's all starting at my business account and then flowing to me personally, whether and my salary isn't all the money I get out of it. I am able to take those distributions as well if I need it. But I think people get confused. So the payroll piece is really easy also if you have them at the same account, like the same bank.
Yeah, I think the people who have to use personal money for business expenses inadvertently are generally people who are more like starting out, right? I'm starting out as a realtor. Like, I don't have sufficient commissions coming in, but I do have expenses that I want to claim them as business expenses. But I love that you touched on payroll because I think that's an area, especially for realtors, we see a lot of mistake on. People tend to think that payroll is something that's sort of set. So like, I am on the same monthly payroll all the time. And that's okay. I think people also tend to think, well, I need X dollar amount of payroll because that's what I need for living expenses, right? But that's actually incorrect. What I always tell people is how much you take out in payroll should not be dependent upon what your living needs are. It is a strategic number because the reason we have an S corporation, the reason we save taxes is actually by paying us the lowest amount of payroll. And so if my payroll is what I need to live off of or the whole profit, now you've actually just overpaid in taxes. And, for realtors, obviously it's no secret, income is cyclical. Or seasonal, right? Or unexpected. And so what I always recommend people is in this industry, we start out with a very low payroll for the first 10 months out of the year. And if we do better than we expect, we always pay ourselves a bonus. But if you start out the gate with, a higher payroll every month, unfortunately, you can't undo payroll. And so you end up
Right.
overpaying 15% taxes for, no good reason.
Right. And that is the reason behind making that S-corp election, to my understanding, is so that you're avoiding some of those self-employment payroll taxes if you're filing as a sole proprietor, where you're not taking that S-corp election. Am I right on this?
Yep, exactly. And
Okay.
sometimes, and I think, we all want to be very optimistic. People are always like, yes, I think this year I'm going to make $300,000. But I always tell my clients, well, that's great. I hope you make it, but let's assume you're only going to make 100,000, and then we'll do payroll from that. And in fact, if you're going to buy a car to write it off, maybe we think we'll make 50,000, so let's start low.
Right.
Because it's silly to overpay, the IRS if we
Right.
don't
And
need
I
to.
think that was the problem I had. Even though I was using a CPA, I don't feel like I got the proper advice early enough. I think I definitely should have gone to S Corp a lot sooner. And I feel like everything in my finances, as far as my business goes, made more sense once I made that election. I was paying a lot of money in those self employment taxes before I made that transition. And I don't know why, but I had a couple of CPAs that felt resistant to it before someone was like, it's time. Do you have any advice for when that, like, I guess, I just don't know. Is it that complicated for a CPA to do this? Why don't they want to do it?
I don't know.
You're like, I couldn't
Oh gosh, CPAs are there's anybody could do taxes, and you have to understand. So not all tax preparers are CPAs. You actually don't have to have a college degree and to sign tax returns. Anybody could sign a tax return. So for some people, it's complicated if they do just only individual returns. A corporate return is sort of like a big deal, but also just not everybody um, does planning. I would say that most accountants don't do planning. And so what happens, especially for realtors, again, it's like, well, I started out my realtor business and I made $50,000 last year. So, okay, maybe I'm okay being an S corp because, as an individual or LLC, because I, save a little bit of tax. But then next year I made 250,000. But if you're not planning with your accountant, they don't even know until the following April. Oh my goodness, Katy, great job. You made so much money. Well, now we have to just pay the tax because we didn't plan for that ahead of time. So sometimes it's also just lack of communication. And I know when we talk about I tell people you should do tax planning, and they hear this big word and it's like, oh my gosh, it sounds so terrible. Like I have to tax
right.
plan. But if you think about it, tax planning has nothing to do with you and numbers and receipts. It's really just a conversation with your accountant. And it's really just about like, what's going on? Like, how's business? How are you getting your leads? What do we think we're going to do in profit? This very conversational. And it's in those conversations, your accountant will be like, wow, Katy, you're on track to make $250,000. Let's get you into an S corporation,
Right. Because you can't go backwards. Like you have to have it done on the front end. So it's tough.
Well, yes and no. So here's a tip. If you operate in your personal name and at tax time your CPA finds out you earn 250, then yes, it is too late. We cannot assign income to an entity before it was born or created. Okay. But what you can do is you can form an LLC. So let's say right now we form an LLC, we start earning all of our commissions in the LLC, we pay expenses out of the LLC. We can stay as an LLC for the whole year because I'm not sure if we'll be profitable or have a loss. But in that scenario, if by the end of the year you realize you've made more money, you can talk to your accountant and then they can make a late S corp election. So it's still the same entity, still an LLC, but your accountant is going to choose for you to file tax returns as a corporation. And you can, make that change retroactive and be able to save on taxes for all of, this year since the formation of the entity. So that is a little bit of a workaround for those of you who are like, I'm not sure if I'll make a lot of profit. I might maybe start out with a single member LLCs to give yourself that flexibility.
Okay, that's a really good tip. Good to know. If you are making it's a few years in and now you've gone up in production, let's say you're consistently more of a top producer, you're getting a higher income, the tax planning obviously is still very important. What are some tax strategies to consider at this level when you're maybe making, more money than just getting by or just barely making into that amount where you need to think about an S corp? Like, what if you're consistently producing a high number?
Well, I mean, I think first off, at any level of income, we always want to make sure we maximize our write-offs. I think that's a common mistake area. Is not especially as realtors. There's a lot of overhead expenses that are kind of blurred, personal slash business, and so all income levels want to make sure we capture all of those: home office, car write-off, travel, business meals, open house, like all of those things. Even though there's kind of some personal enjoyment benefit, making sure you capture that. At higher income levels, outside of that, beyond entity planning that we just talked about, retirement planning is a huge one. If you're someone who makes, I don't know, $1 million or $800,000, or even lower, you could potentially put, over $250,000 into retirement and take a tax write-off for it. So pretty significant, right? You're looking at, I'm either going to pay that money to taxes or I'm going to put that towards retirement account. And I use that as an example of high income. But, if you're someone who made $200,000, you can also, do retirement contributions, right? So 401k, solo 401ks, pension plans, those are all things that you can set up even as like a, sole proprietor, individual owner. You're not required to have a corporation to use some of these strategies. But I mean, obviously my favorite one, like I said earlier, I'm going to turn everyone into investors, is that if you're a realtor, you should definitely consider investing in real estate, because rental real estate could provide pretty massive tax savings. That's one area where for some of our clients, they're taking the income earned from their transactions, putting that into rental properties and really being able to use the investments to, not just cash flow and appreciate, but also eliminate their taxes on their commissions as well.
Okay, take us down that road. What are some of the strategies if you are going to purchase an investment property to help with your taxes?
Well, I mean, as real estate investors, not only do you get all of the usual like tax write-offs and those kinds of perks that you do as a realtor, but we also get what we call depreciation. And depreciation is basically a tax law. We call it a paper loss because we're not actually losing money. The property is appreciating, it's doing well. But the IRS allows us to write off the purchase price of a building over time. So if let's say I bought a $600,000 property and the building was $500,000, I can depreciate that building over time. Depending on the tax law, first year depreciation with some more advanced strategies might get you anywhere between $70,000 and $150,000 of just depreciation itself. And again, we like that because we're not really losing money. We're just literally taking a paper write-off on that. With respect to real estate depreciation, it's based on the purchase price of a property, irrespective of what your down payment is. So as an example, if you bought that $500,000 or $600,000 property with 15% down, right? Your down payment is going to be less than that first year tax write-off you get. And so it could be, pretty significant. And especially, as a realtor, you see the deals, you see which properties work, which properties don't. So it's almost like a no-brainer, right? Like you're almost just like walking by an opportunity to build wealth and save on taxes. Might as well just bend down and pick it up.
And do it. Okay, this is so great. I wish that Alissa were here, but I did get some questions from her. She owns several rental properties. Okay, so she is an investor. She owns property. And her question is about depreciation. She's like, okay, let's say you depreciate the full amount you can on a property. You'll have to give me some number specifics, but you depreciate the whole amount. Obviously, over this time, the property itself is appreciating in value. What happens when you go to sell this property, or does this method only work so long as you hold on to it? And are we just assuming we're going to hold on to it forever?
Mm-hmm. Well, so depreciation basically, like I said, it allows us to write off the purchase price over time of a property. Generally, it's not going to be fully written off or depreciated because normally, the building you own it's depreciated over 27 and a half years. So
Okay.
Fully depreciated for context is after 27 and a half years. So we'll always still have some depreciation, some basis. But depreciation does increase the gain when you sell a property. So if I bought something for $100, I already depreciated $20. Now my basis is $80. So if I sold it for $100, now I have gain of 20, right? Because I already wrote off 20 of it. Now, with respect to the sale in the future, the question is, when do you sell it? So if I'm buying a property, I'm going to sell it in 5 years or 10 years. The question becomes, do you want to pay less taxes year after year for the next 10 years? Or do you want to pay, the maximum amount of taxes to avoid the gain on sale 10 years later? So it's really the time value of money. And I think for most people, the goal is I want to pay less taxes now because that's me having time with my money. So my money could be reinvested and growing, right? Because we know that if we pay the IRS in April, that's it, it's gone. It's not coming back. There's no investment. There's no ROI. But if I didn't have to pay, then I could invest that. Even if it's just for 10 years before I do have to pay the tax, I got 10 years of growth that I otherwise didn't have. So that's one aspect of it. Now, this is not a one size fits all for everyone. There are people who are like, well, maybe my income will be higher, in 10 years or whatever the situation is. I think the other thing to consider is, yes, for most clients who invest in real estate, if real estate is their wealth building vehicle, they typically want to stay in real estate. So if they were to sell this property, it's generally to trade up into bigger, better performing properties. In those scenarios, they can do a 1031 exchange, which means they continue to defer the tax. And yes, speaking a little bit more morbidly, if you keep that until death, oftentimes it is passed on to the next generation. And in the tax world, we have what we call step-up basis, which means if you bought something for $100 and by the time you pass away, it's worth $1 million, no one pays the taxes. The kids get that at $1 million valuation. And if they were to sell it, the first $1 million is not taxed to the family. So those are kind of some longer term play in terms of what happens when we take depreciation.
Do you love listening to the podcast but miss us the rest of the week? Well, you can come follow along on social media and see our faces all week long. Katy, where can they find us?
You're not going to believe this. We're on Instagram, YouTube, TikTok, LinkedIn, Facebook, Threads, Pinterest, MySpace, Clubhouse, and Vine. Just kidding. We're not on MySpace, Clubhouse, and Vine.
No. But you can follow us at any of those at Hustle Humbly Podcasts. So come hang out with us. We'd love to see you there.
Okay. And I'm going to put my hat on and pretend like I'm her. She said, okay, but what if I don't want to save the money for my kids when I'm gone? I want to use the money when I'm alive, but maybe I don't need to use it today. So we're deferring the taxes. She's like, I'm just kicking the can down the road. It's not actually going to be less when I pay it. But your theory is you're able to then have your money and use it to maybe buy another property that's going to gain value over the same period of time where you could have paid the taxes and had nothing to show for it.
Exactly. Yeah. So my question is, do you want to pay tax now or do you want to pay taxes 20 years from now, right? Like you're going to have a tax bill of $100,000. Do you want to pay today? Do you want to pay it 10 years from now? And I think most people will say, well, let me spend the next 10 years with my $100,000. I'll do something with it, even if it's sitting in the bank, and I'll pay later on. But also important to understand there is potentially what I just discussed, we call it temporary savings, saving taxes now, but paying later. There's also the possibility of what we call permanent tax savings, which means I am never paying the tax. And the difference could be, let's say for Alissa, if right now she's in her earning years, making lots of commissions, and she's at a 32% tax bracket, right? Because she's earning right now. And let's say 50 years from now, she is retired and just living off of rental income, maybe some dividends or sell some stocks here and there. Well, at that time, she's probably not at 32% tax bracket, right? Because the earned income is gone and she's living off of investment income. So if we're talking about stocks, long-term capital gains is taxed at 15%. When you sell real estate, a lot of that is taxed at 15%. And so this is what we call permanent savings, because now we are taking a write-off at 32, 37%. In the future, when we pay taxes, we pay it at 24%, we pay it at 15%. And so, yes, I have effectively saved true taxes across the years as well.
Okay, this makes perfect sense to me. It would be the only reason why she would worry is if she knew she was selling in 5 years when she plans to be producing the same amount. And even
Yep.
then, not paying more taxes, she's just paying them at a later date.
Yes. Yeah, potentially. And then, we'd also want to know, like, are there other ways to offset the gain in 5 years? Like, is she going to buy other real estate? It doesn't have to be a 1031, but is she going to buy other real estate? Is she going to sell some stocks or some crypto? And that's where the planning comes in. We do planning with our clients. Those are the kinds of things that we're looking at, right? Like in 5 years, if you have some major life event you think is going to happen in year 5, we can start looking now and say, okay, what do we hold? What do we buy to help account for that? And I think for a lot of you who as like an agent or an advisor to your clients, we see this all the time. Someone is going to, wherever they work is going to get a big stock IPO or something, 3 years from now. We say, well, let's start buying real estate now so that we can plan in year 5. You already have a portfolio. We can use different strategies to unlock some of that benefit.
Okay, I love that. It's a really good plan. Just revisit depreciation really quickly. What if someone is listening and they own a rental property, but they never took the depreciation? Can you start once you're already owning it, or do you have to start the year that you purchase it?
Well, first I'll say if you own real estate, you never took depreciation, you need to have a new accountant. If your accountant tells you don't take depreciation because of recapture, pay more taxes, you have to get rid of that accountant. Because depreciation is not a choice. You don't choose to take it or not. It is actually a requirement. What that means is if your accountant told you don't take depreciation because of XYZ, when you go to sell the property, the IRS will treat it as if you took depreciation. So you are still getting recapture. Yep. It is not a choice. So under no circumstances would you not take depreciation. Now the choice though is, how should I take depreciation? How do I optimize it? For some people, we want to take as much and as soon as possible. For others, we want to take the slowest that the law requires us to. So that's a little bit of like a planning, but everyone should take depreciation. If you have not taken depreciation in the past, you can do a catch up. So it's what we call an accounting method change. My method was going from wrong, not doing it, to right. Now I'm doing it. And it's like a 10-page form that your new accountant, right, because not working with the old one, is going to have to file for you. That basically tells IRS, hey, I didn't do these things. I'm not going to be doing it correctly. And so that's the good news. You don't lose it. You basically get to catch it up because it is a requirement.
Okay, very good. Good to know. Let's revisit retirement again. When you're talking to an entrepreneur or someone who is self-employed and you're talking about retirement in the context of real estate, what is your best advice? How to get started? What is a good plan?
Well, I think it's, also there's not a one size fits all for retirement purposes. So I would say, first for our clients who are realtors, we start with the conversation of the ordering of it is, okay, first we maximize our write-offs, right? Because that's a no-brainer. Next, rental real estate, right? Are you using that to build wealth? Because a lot of times through rental real estate, you already drastically lowered your tax rate, in which case we don't really need retirement account. Because if I'm already at like a low tax rate, maybe I just want to keep my cash and buy more real estate. But if you're not doing that, then retirement account is one of the ways you can still reduce your tax bill. And in fact, we could still do it now for last year's taxes. For a lot of self-employed people, you have until you file your tax return to open and fund retirement accounts. And that includes 401ks, defined benefit plans. I think the things to look at is what is your available cash? And always keep in mind when we talk about retirement accounts, it's money we're saving for the future. We don't want it to be like, I'm putting it in, but I'm probably going to need to take it out for the kids or vacation. So how much do I have earmarked that I actually can save for retirement? And then we back into what is the type of plan. Because if you're just wanting to put in $7,000, that's a very different plan than if you wanted to put in $30,000. Then that's also very different than if you wanted to put in $200,000, right? So we always start with like, what is the available cash you have to put in? that you're okay to part with it, earmark it. And I think the other question too is, what do you want to invest in? If you're wanting to invest in stocks, right? Instead of using your cash to invest and it's taxable, we put it in the retirement account, get a write-off, and the retirement account invests in it, and now it's going tax deferred. But you can also use it for real estate. We have clients who are like, well, let me put it in my retirement account, get a write-off, and then in the retirement account, use that money to go out and buy real estate too. So a lot of fun planning around retirement
How does that
contributions.
work? If it's is it a certain type of retirement account you have to use?
Yes. So it's called a self-directed IRA, self-directed 401k, just the self-directed before the regular account name. So you can self-direct all types of retirement accounts. The key is making sure you're working with the right custodian. Okay. So the self-directed custodians are companies that don't give you assets. So they don't, like a typical Fidelity or Schwab, they have a portfolio like, large cap, small cap, mutual funds. And they'll tell you it's self-directed because you can choose, right? Apple, Tesla, whatever. But a true self-directed account, the ones that you can use for real estate, they don't give you anything to choose. You open the account and they say, well, Katy, what are you going to invest in? You go out, Katy's IRA makes the offers, the account funds it. So the custodian doesn't give you any options to pick from because you're picking. You're in the world shopping for real estate, notes, businesses.
Are there any companies for that you typically recommend?
Yes, so many. So UDirect IRA is a good one. The little U Direct IRA. Equity Trust Company is another really great one. Those are, two of my favorites. But yeah, there's a lot of them out there. I think the keyword you're searching for is self-directed. So self-directed IRA. And again, the warning sign, because people tell me this all the time, like, I went to my bank and they also allow me to do self-directed. The banks are typically not self-directed. Schwab is not self-directed. When they tell you they're self-directed, they just mean I allow you to pick whatever stocks, bonds, and mutual funds, right?
You get to be involved, but you don't get to take the money and do whatever you want with it.
Yes. So true self-directed. And if you want to know, you just tell them. And some people say, can I invest in real estate? They'll say, yes, you can. But they're talking about like REITs.
Their portfolio.
Their REITs, yes. And so you tell them, like, if the question you ask them is self-directed, like, I'm going to buy a property on 123 Main Street. That is the self-directed. I chose the property myself.
Yeah. Okay. Oh, this is very, very good and fascinating information. I think it's been so helpful. Do you have any other tips or advice that you feel like is important for the realtor community to hear?
I think it's, like I said, spend time, a little bit of time, thinking about your money and finances, because, it's equate to like plant, right? The more attention you give something, the faster it blooms. And so we don't want to just spend all of our time on making money. We just as importantly want to make sure we spend the time to protect the money that we earned. And, and tax planning is not scary. Accounting, bookkeeping doesn't have to be tedious and scary. You just have to make sure you have the right team, the right systems. And I think kind of like what you said, Katy, like once it's set up, it could be very automated. It becomes second nature. It's part of what is done by you or a team member. It doesn't have to be all consuming. And if you feel like it's all consuming, it's probably your sign that you need the systems.
Yeah. And I'm a big systems fan in all facets of your business. Once you get the thing set up and you just tell yourself this is the way it has to be done, it's pretty easy to keep up with it long term. It's the avoiding setting up the system that really causes you the most pain, I believe. And this definitely makes sense that it would happen the same with your money and accounting. Okay, Amanda, this has been absolutely delightful. Will you please tell people where they can find you if they want to learn more and learn from you? I know they're going to want to.
Sure. My husband and I wrote 2 books that you can find on Amazon, Barnes and Nobles, anywhere books are sold, called Tax Strategies for the Savvy Real Estate Investor. It's about real estate investors, but I highly recommend you read it because obviously have clients who are investors. And so you're more educated on what you can share with them. I have realtor clients who give out books for free to their investor clients just to help them and build goodwill. If you're looking for more tax help and tax updates, my company is called Keystone CPA. So you can go to keystonecpa.com. I have a YouTube channel. And I'm also very active on Instagram for daily tax tips. And for both YouTube and Instagram, you can find me as Amanda Han CPA.
Perfect. Thank you so much for being here. This was very helpful.
Yeah, thanks for having me.
Yeah, no problem. Did you bring someone you'd like to toast to for the end of the show?
Yeah, I think I'm going to have to give a toast to my husband who's not here. He's usually with me on the podcast. But I just, I always tell people that we are such a good team because we're so opposite. I'm kind of the more like creative one, and he's like more the analytical and detail oriented one. And you sort of need both in an accountant. And so it's, we're very opposite, but I think it works. Having a good home life, I think is the pillar to success, in business. And
absolutely. Awesome. Well, cheers to him. I love it. Okay. Well, thank you so much for being here. We really do appreciate you. And everyone will go check out Amanda wherever you want to.
Yes. Thanks for having me.
Okay. Bye. Thank you.